Most people, a lot of experts will say, with the Fed printing all this money, it'll be leading towards inflation, right? $3 trillion, $4 trillion in the last few months popped the stock market. And that's one of the ways it's shown its ugly head. But you're saying the complete opposite. It's deflation that's coming. Maybe why is the whole inflation story not true?
First of all, it hasn't been true for 13 years. Go back to 2009. Between late 2008 and 2009, the Federal Reserve expanded its balance sheet from about $800 billion to something just under $4 trillion. So they increased it by 300%. And everyone's like, oh my goodness, they're printing all this money. We're going to get inflation. We never got inflation. We didn't have inflation for 10 years. We still don't. The money supply has nothing to do with inflation. Milton Friedman was wrong about that. The Austrian school was wrong about that. The neo-Keynesians are wrong about that. Inflation is not caused by money printing. Inflation is caused by velocity of money. It's the turnover of money. So you can take the Fed balance sheet to 7 trillion. My friend, Stephanie Kelton, she's the big brain of modern monetary theory. They say, why can't it be 10 trillion? The answer is it could be 10 trillion, but it's not necessarily inflationary unless you get the turnover. So I'll give you a simple example. Let's say I go out to dinner and I tip the waiter. And the waiter takes the tip money and takes a taxi or an Uber home, tips the driver, and then the driver takes the tip money and puts gas in his car. My $1 had velocity of 3. It supported $3 of goods and services, the restaurant tip, the taxi tip, and the gas. But what if I stayed home and watched TV? Then my money has velocity of 0. I didn't spend my money. There was no turnover. And I remind people, $7 trillion times 0 is 0. In other words, if you don't have velocity, I don't care how much money you print. If you don't have velocity, you don't have an economy. Velocity has been dropping for 22 years. It started to drop in 1998. It's been coming down ever since. Now, it had larger spikes down in the 2008 global financial crisis and the 2020 pandemic collapse. The clear line has been going steeply down, and it's still going down. So my point is, and we need inflation. Inflation is not good in some ways, but you can't print your way out of a liquidity trap. You can't borrow your way out of a debt trap. The only way to get out of it is with inflation. And the only way to get inflation is to change the psychology, because it's not controlled by money supply. It's controlled by how people feel. And right now they're savings rates are sky high. It's precautionary savings. People feel the prices are going to get lower, so they defer consumption. Now, I'm talking about consumer price inflation, which is what the Fed looks at and what policymakers look at. If you think the stock market is inflation, I can call it an asset bubble. Yeah, stock prices are going up. That's not inflation as economists and policymakers understand it. Those are just asset bubbles, and they are happening. So the money has to go somewhere. I've heard of people got these $1,200 checks around last June, May and June. They're probably going to get another $600 in the next month or so. What are they doing with the money? Some people are paying their bills, but a lot of people are investing in stocks. You got all these newbies. They're on Robinhood. They're first-time investors. They don't really know what they're doing, but they know that stocks only go up. They're not spending the money. They're investing in the stock market. They're just inflating the bubble, not doing anything for the real economy, which would come from spending. And there's something to be said for savings, but that's what people are doing. They're saving the money and investing the money. They're not spending it. So the money printing doesn't work.
Yeah, no, it makes total sense. The money's out there. It's just the government needs to try and find a way to incentivize throwing it into the real economy, getting that abundance mindset for consumers.